Hello everyone. So today is our first week of the second quarter lesson with the subject fundamentals of accountancy, business and management too. So today we are going to have a new topic. So our lesson for today or our topic for today is all about accounting books, journal and ledger. But before that, let me first read to you the objectives. At the end of this module or lesson, you are expected to A. Differentiate the journal from the general ledger. Determine the normal balance of an account. Prepare journal entries to record basic business transaction. And letter D. Determine balances of accounts using the T account. So, as what I have told you a while ago, our lesson for today is all about accounting books, journal, and ledger. So companies initially record transactions and events in chronological order. So the order in which they occur. So thus, the journal is referred to as the book of original entry. So for each transaction, the journal shows the debit and credit effects on the specific accounts. So the journal is a chronological record or the day by day of business transactions. So it is called the Book of Original because it is the accounting record in which financial transactions are first recorded. So the general ledger is commonly also referred by accounting professionals as GL. So this general ledger is a grouping of all accounts used in the preparation of financial statements. So the GL or the general ledger is controlling account because it summarizes all the activities that have taken place as recorded in its subsidiary ledger. So the ledger refers to the accounting book in which the accounts and their related amounts as recorded in the journal are posted to periodically. So the ledger is also called the Book of Final Entry. Why is it Book of Final Entry? It is because all the balances in the ledger are used in the preparation of financial statements. So this is also referred to as the T account because the basic form of a ledger is like the letter T. Since accounting is the process of identifying, recording, and communicating economic events of an organization to interested users according to Weigand et al., so journals and ledgers can be compared to a personal diary. Why is it's compared to a personal diary? It is because they are used to record the day-to-day transactions of the business. So we have here two major types of books of accounts and journal ledger. So those two major types are, so we have here the first one, the general journal and special journal. So many businesses maintain several types of journals. The nature of the business, operations, and the volume of transactions determine the type and number of journal needed. So the simplest type of journal is called the general journal. So the process of recording a transaction is called journalizing the transactions. So this type of journal is unique among journals because it may be used to record any type of business transactions. So recording all transactions in the general journal is not cost effective and time consuming. So to speed up and simplify the recording process, most businesses make use of special journals. So each special journal is designed to record a particular type of transaction efficiently and quickly. So here we have examples of special journals and their use are the following. So first one, we have the cash receipts journal. So this is used to record all cash that have been received. Second is we have the cash disbursements journal. So cash disbursement journal is used to record all transactions involving cash payments. Third is we have the sales journal or the sales on account journal. So this is used to record all sales on credit or on account. And then the last one, we have the purchase journal, or the purchase on account journal. So this is used to record all purchases of inventory on credit or on account. So the importance of using a journal is to show all information concerning a particular transaction. So it also provides a chronological record to all the financial events in the business over time. So if you want to know about a certain transaction of years or months back, we can trace the said transactions as long as we have the date of the said transaction. So the entries in the journal are arranged by date that makes it necessary to locate a particular event. Next is we have the use of general ledger. So a ledger is a means of accumulating in one place all the information about changes in an asset, liability, equity, income, and expense accounts. So we have here a sample of the general ledger. So we have here below. This is an example of a general ledger. So a general ledger is often called a T account because of its resemblance to the letter T. So a T account is simplified form of general ledger. So a sample of a T account is shown here. So we have here T account here. So we have the account title. For example, our account title is cash. And then on the left side is the debit side, and then on the right side is we have the credit side. Okay, so at the account for each of the account titles listed on the said chart is prepared to determine the balance at the end of the period of each account. So we have here the chart of accounts. So here we have account code, the account type. The first column is the account code. The second column is the account title, and we also have the classified by the type of major accounts. So when you say under the statement of financial position accounts, we have cash. Here we have cash, accounts receivable, and allowance of bad debts. So those are under assets. Next, we have here inventory, prepaid expenses, supplies, office equipment, accumulated depreciation, store equipment. We have accumulated depreciation of store equipment, transportation equipment, accumulation depreciation of transportation equipment, and then building, accumulation depreciation of building. We have land and intangible assets. So those are under assets. And then for liabilities, with the code, you just have to remember that when you have to classify major accounts, assets, the account code for assets should start with 1. And then for liabilities, we'll start with 2. And then equity will start with 3. So based on what we have observed on our example. So liabilities, we have accounts payable, notes payable, accrued expenses, salaries, utilities payable, and then income taxes payable. And then for equity, we have the owner's capital and then owner's withdrawal. And another one. This is for income statement accounts. So for under the income. So for income, it should start, the account code should start by 4, and then expenses should start by 5. Okay. So for income, we have the service revenue, we have sales, sales returns and allowances, sales discounts, interest income, cost of sale, purchases, purchase returns and allowances. We have purchase discounts, freight in, salaries expense, supplies expense, utilities expense. We have the communication expense, of course. We have travel expense, rental expense, the fuel expenses, advertising expenses, delivery expense, commission expense, and we also have depreciation expense, taxes and licenses, and of course, interest expense. So, in order to determine the ending balance of each account using the T account, the beginning balance is plot in the appropriate debit or credit side. So then total debits and credits are then determined. So if the account has a beginning balance on the debit side, all the debits during the period is added to the beginning, then all the credits are deducted. So this is a debit balance of the account if the sum of the beginning balance and the total debits exceeds the total credits. So we have here the normal balances of these accounts. So for asset accounts, we have the debit balance. However, the normal balance of a contra asset account is credit. So in the above chart that I have shown you a while ago, the contra asset accounts are, we have the allowance for bad debts, accumulated depreciation, store equipment, accumulated depreciation of equipment, accumulated depreciation of transportation equipment, and then accumulated depreciation of buildings. Second is we have the liability accounts. So liability accounts are those credit balance. Then for equity accounts, those are owner's capital account has a normal balance on the credit side, while the owner's withdrawal account has a normal balance on the debit side. And then fourth is we have the income. So income is under credit balance also. And expense. So expense is also under debit balance. So based on the table that I have shown you a while ago, asset accounts is under debit, liability is under credit, equity is part of credit and debit, and then income is credit, and then expense is a debit balance. So we have here a summary of the normal balance of the account. So we have on our first column, we have the statement of financial positions accounts. So we have the assets, the liability, the owner's capital, owner's withdrawal, income, and expense. So this is what I have told you on the last slide. So the increase in the normal balance is for asset is debit. So when it decreases, it becomes credit with a liability credit to debit. Then owner's capital is credit to debit. Owner's withdrawal is debit to credit. Same with the, no, it's income. When income is credit to debit, and then expense is debit to credit. And then so, when an account that normally has a credit balance actually has a debit balance. So it may mean that an error has occurred or that an unusual situation may exist. So for example, the accounts receivable account normally has a debit balance. So if at the end of the period, the actual balance is on the credit side, it may mean that there was overpayment of the customer or an error in the recording process has occurred. So that could be all for today, and see you next meeting. So thank you and goodbye.